Modern high-performance electronics require more physical silver than the global mining industry currently produces. Every AI processor and high-efficiency solar panel relies on the literal physical conductivity of this metal to function. In January 2026, gold pushed past $5,000 an ounce, and silver climbed above $80. Viewed against 50 years of data, this current trajectory is a structural anomaly. It departs from standard economic models, moving far beyond the inflation-adjusted highs of the 1980s. Institutional behavior explains the shift. Central banks, led by emerging markets like China, are absorbing hundreds of tons of physical gold into their reserves, while industrial firms are beginning to stockpile silver to protect their manufacturing lines from supply deficits. This concentration of physical assets is a strategic move against the dollar-denominated financial structure. These buyers are looking for a hedge against the system that provides the United States with its exorbitant privilege. The modern system began here at the 1944 Bretton Woods Conference. The agreement established the US dollar as the world's reserve currency, pegged to gold at $35 an ounce, while all other currencies were pegged to the dollar. This created the Triffin dilemma. To provide the world with enough liquidity for trade, the US had to run persistent deficits, mathematically ensuring that the number of paper dollars in circulation would eventually far exceed the country's physical gold reserves. By the 1960s, this imbalance reached the silver market. Industrial demand for silver began to double annual production, and citizens began hoarding silver coins, realizing the metal in their pockets was worth more than the face value of the currency. To protect the remaining government supply, President Lyndon B. Johnson signed the 1965 Coinage Act. This law removed all silver from the U.S. dime and quarter, replacing it with a composite of copper and nickel. Removing silver from common coins was the first major decoupling of money from physical reality. It allowed the U.S. to maintain dollar liquidity by transitioning to a fiat system, a currency not backed by a physical commodity like gold or silver. The math reached a breaking point by 1971. The U.S. held only 10,000 metric tons of gold in reserve, less than half its post-war peak, while foreign central banks held billions in paper claims against that gold. French President Charles de Gaulle challenged the arrangement, demanding that the United States convert France's dollar holdings into actual bars of gold. He viewed the dollar's status as a mechanism that forced other nations to subsidize American spending. On August 15, 1971, President Richard Nixon responded by unilaterally closing the gold window. He suspended the direct convertibility of the US dollar into gold, effectively ending the Bretton Woods system. This transition granted the United States the ultimate privilege, the ability to issue the world's primary reserve currency without constraint from a physical metal supply. The dollar was now backed solely by the authority of the US government. This change allowed the U.S. to finance massive budget deficits by exporting its debt and inflation. Because the world needed dollars for trade, other nations were required to absorb the excess currency produced by the American Treasury. After 50 years of this arrangement, the mechanics of the system are under strain. Decades of rising debt and the recent use of financial sanctions have prompted other nations to reconsider the dollar's role in their sovereign reserves. This chart shows central banks actively de-dollarizing, the process of reducing their reliance on the US dollar. They are replacing US Treasury debt with physical gold, which carries no counterparty risk and cannot be devalued. Silver is seeing a similar flight to physical metal. Industrial demand from AI and green energy is now consistently outstripping new mining supply, creating a physical deficit. This has created a dual-pronged supply squeeze. Buyers are moving away from paper-based contracts and digital promises, seeking the protection of tangible assets that exist outside the fiat financial system. The 2026 price surge is the result of this move toward physical settlement. It marks a clear, data-driven shift as the world's largest economies seek to limit their exposure to the dollar's exorbitant privilege.